So the next one is shorting of shares. And I was mentioning on Friday, I think it was, that I did believe I had done something in our Facebook group for shorting. I was pretty sure I had. And when I went here, if you go, I think I tagged some people. I also put the link in I put the link in our Telegram group. If you wanted to watch the videos, I did a coaching call in February on short selling. So this is it's how to short sell. So when I was searching for it on the call yesterday, I was putting in shorting. That's why nothing was coming up. But this is a whole call on how to short sell stocks. And it's an hour, almost 2 hours. It was one of our Saturday coachings, but it's a lot more in depth. What I think I will do though, now that I found the video, I am going to add it to the bundle that we have. I have a bundle of courses that includes all the different stuff. I'm going to add it to the bundle because it should be something that we use. So I'm going to add it to, this is our course bundle. I'm going to talk about this in a second, but I'm going to add shorting to this. You get access to everything. If you just want to watch the sellers video in the Facebook group, you can do that. How to short sell stocks is what the name of the video is. I think I tagged some people in it. Saida found it. I put the post in the Telegram group. I listed it this morning. I think I mentioned this Facebook coaching call on short selling stocks. You're free to go watch it there for free, for the free. Yes. Okay. Back to where we are. I'm going to hit an overview of it though, of shorting. Basically, when you're shorting, you are borrowing shares from the broker. You're going to sell them at whatever price you choose, and then you're going to buy them back at a lower price. Hopefully, you want to buy them back at a lower price. And you keep the difference in the price. So you say, I'm borrowing them from the broker for $10, but I'm going to give them back to the broker for $9.50. That means I keep 50 cents per share, depending on however many shares you decide you're going to short. Then you can do it that way. Shorting is the opposite of going long. So if you're just buying shares, of course, your expectation is that they go up. If you're shorting shares, you're saying you are hedging. It's a hedging technique. So you're hedging and you're saying, if it goes down, I want money back in the process of it going down. You cannot have shares and short shares in the same account. Right? So if you have a margin account and you own 200 shares of SoFi, you cannot short shares in that same account. You'd have to be in another account to short. You can't short and you can't buy, because basically shorting means you're selling them. And you would basically be selling the shares you already own. Okay, so you can't short and have shares in the same account. But you can short shares when you have a long call. Let's say you have a call on SoFi for $6.50 and you want to short 100 shares. You can do both of those in the exact same account because you're not you're just hedging. You're not counteracting. All right. Hope that was clear. Short selling gives you dollar for dollar. You know, when we're doing options contracts, you're getting paid based on delta. So if the delta is 0.5, then for every dollar, you're making 50 cents. But with short selling shares, you're getting dollar for dollar. If it moves down $1, you get $1. If it moves down 50 cents, you get 50 cents per share. But the opposite happens. If it goes up 50 cents, you're paying 50 more cents. If it goes up $1, you're paying another $1 per share. So it's a 1-for-1 going either direction. You use shorting shares when you don't want time expiration, because you can have shorted shares in your account. Once they're in there, they're there until the broker either calls them back, which I don't know if that happens, or you decide you're going to close the trade. There's no expiration time on shorting. You use them when you don't want to trade it as an options play. Maybe you decide something's going to go down, but you don't want to buy a put per se. You just want to short it. You can do that. It can be an alternative to buying an option. Good thing about shorting, I put the pros and cons on here. There's a possibility of some high profits depending on how many you short and how things go. There's little initial capital required. If you're shorting and you already own a call, then your shorting money is really pretty cheap. We're going to do some examples here in a minute. You can leverage your investments if you want. Hedge against your other holdings. So you're basically hedging against something you already have. The cons is that you can have unlimited losses in that you decide I want to short it at $10, but the stock runs to 20. But you want to short it one place and the stock goes up, then you basically you're going to either need to hold the shares until it comes back down, which you just know stocks usually go up more than they go down, or you're going to have to close out and pay the difference. You need to have a margin account to do short selling. Anytime you're selling something in options or shares or whatever, you have to have a margin account to sell, because they have to, the margin has to be there to cover you just in case you need it. Margin interest is incurred. It's very inexpensive, but when you're short selling, you are going to be paying a little bit of interest on the money. And a con can be a short squeeze, like we're talking about squeezing the other day, that you get into a stock, it has stayed in a place for so long, then it squeezes and goes up. Basically, the stock has started to go up, and you are in a trade that essentially says you want it to go down. Those are the cons there. I think I had some more charts on shorting. Let's go back one. There we go. The steps to shorting is basically you want to identify the stock that you think is going to go down. You want to chart your resistance area. You should decide your exit price. You should determine how many shares you're going to borrow. You go to the stock, pick the trade, sell to open. I'll show an example. And you need to be prepared to buy to close. The good thing about shorting shares is when you're working with shares, you can work outside of the trading hours. Shares fall into the extended hours. So you can start with shares, shorting or otherwise, before market open. I think it starts at 6 or 6:30. If you use the extended hours, and extended hours goes up until 7 or 8 o'clock at night, I think, on Thinkorswim. So you have those extended hours to open and close your trades. You do have to watch to be sure that you are clear on the opening and closing for the day and how those pertain to your day trades. Because if you open a shorting order today and you close it today, that is a day trade. If you open a shorting trade during the day and you close it after the market closes, then that's not a day trade, but then that trade is now going for a subsequent day. So you have to be mindful of when there are the times, what are the cutoff times for shares days, okay?